Hello, and welcome to AGH Wealth Management's 2021 Outlook webinar. Both Brian and I appreciate you taking time out of your busy day today and allowing us the opportunity to share our thoughts and that of our independent broker-dealer, LPL Financial, on the outlook for this next year. So, probably as will be said multiple times throughout this today, 2020 was an unusual year, to say the least, with extraordinary challenges. But now we're here in 2021, and it's time to restart our engines. But things are going to look different. They're going to feel different. 2020 has changed the way we're doing business, and it's changed the way we're connecting. In our outlook for 2021, Powering Forward, we're going to talk about stocks and bonds and the economy and the post-election policy environment. But in the background, again, remember, there'll be new challenges, things that we haven't, even realized or even anticipated, new opportunities, also new ways of doing things. My name's Brad Bechtel. I'm the president of AGH Wealth Management. Every 6 months, our firm provides our insights and our outlooks on the economy and the market ahead. The slides you're seeing here today are available to you, with a color booklet, and we'll be more than happy to send that to you. Just let us know, send us a request, and we'll get that taken care of. During the presentation today, if you have any questions, please type them in that little message box on your screen, and both Brian and I will do our best to address them as we go. My partner in today's presentation is Brian Gensch. Brian's a certified financial planner, and he's a senior vice president with AGH Wealth Management. His focus is on overseeing our firm's personal investment portfolios and strategies, as well as our personal financial planning. At the conclusion of the presentation, both Brian and I will make ourselves available if you've got any questions. But without any further ado, I am going to turn the mic over to Brian.
Thanks. Thanks, Brad. And thanks, everybody who are here. And officially now, good afternoon, since it's now past noon. We, again, appreciate you guys taking the time to let us share kind of our thoughts and where we're headed. It's interesting, because we'll talk about 2020 throughout the presentation as it relates to looking forward. And it's interesting because, we all saw it, but we have these, like Brad said, every 6 months. And I remember we usually, if we're meeting with clients, we might put those booklets in our reviews. And I remember, it was about March, February, March, and we were throwing these in our reviews, and I'd start just taking them and throwing them in the trash in the meeting, because by the time March came around, things were completely different than what the outlook had looked like a month before. So, hopefully, as we talk about 2021, we don't have that kind of environment where we're throwing our material out 1 or 2 months after this presentation. But again, thanks for joining us. 2020, if we talk a little bit about the impact, we're going to stay away from words like unprecedented and historic, and we're going to try to stay clear of all these words we've come to hate. But as it goes for what happened last year, the one thing that has really been on my mind is the impact in our view of the world. And I mean that by as we look at generations and how generations split. I don't know if anyone on the call had been, I think it was a couple years ago at the Global Leadership Summit, and there's a guy by the name of Jason Dorsey, and he's with the Center for Generational Kinetics, and he talked about generation splitting. That's what they study. They study generations and behaviors, and he was relating it to Generation Z. And a lot of times when we think of generations, we think of in decades, in certain decades. But the reality was, in his words, that the split that came in Generation Z was actually a split that happened when 9/11 happened. And if you were too young to remember the world prior to 9/11, your view of the world changed. your behavior in the world is slightly different because what was normal became different. And that's truly what ends up splitting generations and the behaviors you see that are different between them. So 2020, I mean, it was a generation splitting year. And I can say that because I have kids. I have a 6 year old who was praying at the dinner table that the corona would go away so people would stop dying. This is right in the middle of the lockdown. My 4 year old, and this was 2 weeks ago, my 4 year old, I got a picture from my wife right before actually presenting this, pretty much this presentation at a group of people, and I got a text from her. She was going shopping, and I'm going against compliance here, and I'm going to just show the picture. But the picture is of my 4 year old in her mask going shopping, and her a little stuffy, and she insisted that the stuffy had a mask on. Now, my 4 year old's not making a stance here on masks, okay? But what my 4 year old is showing is that she is very comfortable wearing that mask, and it is normal then for her stuffy as she goes out to have a mask on. I think they were going to Costco. So, so what we're seeing here is a change of behavior and what is perceived as normal that a year ago today wasn't normal. And so it is something we need to look at because if behaviors change, it can change how an economy works. It can change how an economy runs, and it can affect the markets. And so we have to be aware of that, even if we have a stance on one side or the other of whether we like it or not. We have to be aware of it because it can change how we view the world and how the next generations will come up and view the same world that we live in today. So hopefully, as we talk through about the stocks and bonds and our economy and a little bit about politics, hopefully that's what resounds in this is that we want to understand how it's affecting us long term. So we're just going to get the politics one out of the way, okay? And this, to be honest, these slides were put together prior not only to the Georgia runoff, but these slides from our broker dealer were put together prior to the election results. And so what this slide was going to show is that split government is healthy for the market. The market likes accountability. We talk about this a lot with clients when we meet with them. So if you're a client, you've probably heard me say that before. But the market likes accountability. When there's a full party in control of all branches, spending can get out of hand. Large policy changes can affect growth patterns. And so historically, if you look back at returns, what the story that you're seeing here is that the markets tend to like split Congress. What this is also saying, though, that I think is important enough to talk about, given kind of how things have played out over the last 3 months, is that the market actually can be positive in any environment from a political standpoint. And while there may be differences in how much the market moves up, we've seen in multiple makeups of our government that the market can move forward. And what I want to point out in that is the market moves much stronger based off of the economic cycles we're in than necessarily who's making policy changes. Policy changes do affect us, and so we're not going to ignore them. But policies do not alter completely and shift the full direction of the market on a dime. And that's important because sometimes we can feel that way based off of if our party is not in in control. And I say our, meaning that we've all had a situation in the last 6 years where no matter what side you fall on, that you maybe have felt that way. But I want to talk a little bit just about, from a political standpoint, what we are focused on. there's a few things that we look at the makeup of this government, and we, from a market standpoint, we say, there's actually some things that could continue to drive the market forward. And then there's obviously some things that we're eyeing because we know they could create some headwinds to the stock market and the direction of the economy. And so just to touch on a couple of those, one of them is stimulus. We know the market has shown a positive reaction to the talks of stimulus, to infusing cash into our economy, albeit whatever way the stimulus is doing it. Cash infusing into our economy creates activity. It creates short-term growth. It creates spending. And what's interesting about this last year is that spending and income have actually stayed relatively strong. In fact, personal income generated as a whole in this country has almost clipped entirely all expenditures, meaning we almost still paid for all of our expenses as a whole without government assistance. So you add the government assistance in, and what we've seen is record amounts of discretionary income. And so any new stimulus coming in, if it's going into the household, the personal household and the consumer, there's a high chance that consumer will spend that money. I mean, we saw that with a lot of e-commerce going on, and we don't want to name names of companies, and because we don't typically do that, and definitely don't create recommendations in these presentations. But you can easily see different companies benefited heavily from us being at home and buying stuff on our phones because the discretionary income was there. And so we've seen a positive reaction to stimulus with the stock market. So with the makeup of the political environment, what we know is, I mean, the number is probably going to be larger the way it played out now than if it would have played out differently. And so I think the market, you've seen some of the reaction in the market, the positive reaction you've seen has been because of that. The second thing that we know the market's focused on is vaccine distribution. When we were back in March and April, we can say we structurally shut down our economy. And I could say, maybe 80% fully shut down our economic activity. And I made that number up, so don't try to find research on that. But we heavily structurally did it. I would look at today's environment and say, we're probably between 80 and 90% structurally open. The difference between structurally how we are and behaviorally how we are is very different, though. We are not behaviorally 80% open. We have a lot of people who are sitting at home waiting for vaccinations to come because they're caring for elderly parents, or because they have health issues of their own, or because they just do not want to get out and spend money if they don't have to until they feel safer. There is a population of our nation that is awaiting that vaccine to reintegrate their normal behaviors economically in spending. So vaccine distribution becomes a really interesting topic because as soon as the vaccine are available, we believe the people who will adopt the vaccine will be the ones who have been less likely to produce economic activity, and that will give them kind of that catalyst to move forward. And we think that is important to the economy and to the markets because that kind of builds in more of the spending, more consumption, more traveling, and some of the areas that are still completely hit hard because structurally they are partly shut down. I mean, you go to a restaurant and there's 50% occupancy because they have to be at 50% occupancy. So we are not fully open structurally, but you're going to see a move much faster to being behaviorally open when the vaccine comes in. I think the market sees that, and that's why you see market bounces with different newses. That's not a real word. With different news of vaccine distribution. I know Fauci just came out, and I think it was this week, and said, Johnson & Johnson and AstraZeneca will probably be out over the next 6 weeks, or a few weeks at least. So we're making some headway there. I know the administration has at least telegraphed that they're focused on this. And not that the other administration would not have been, but that is going to continue to be something the markets react to. The third thing is taxes, and that's the one that is maybe the headwind that we're looking at, because the tax policy that was produced in campaigning with the Biden-Harris administration, if fully implemented, could cut 2021 earnings in half. And so some people feel that that's the risk from an economic and stock market standpoint, that there's that risk there. But I want to talk a little bit about how the blue wave has come. Because in my eyes, it's in, as it relates to tax policy, it's a very small wave. So if you look at the split, I mean, let's look at the Senate. There's a one majority seat, and that's basically a tiebreaker, obviously, by Vice President Harris. So there's our moderate Democrats sitting in the Senate today, and there's going to have to be a lot of convincing to even get to a 50% or 51% majority. You look at the House. The lead of the majority in the Democratic seats in the House is 11 seats. And just to give you a perspective on how small that is, the last time it was 11 or under in the House was 1879 to 1881. So this is, for the generation that's living today, this is the smallest lead a majority that the Democratic Party has ever held in the House. And so having those two things paired together, this is the, I'll just say, weakest blue wave we've ever seen. And that creates a problem for large policy changes, because if you want to change large policies, you have to do it with more than a 50% vote. And so there's going to be a lot of reaching across the aisle that will have to happen for major economic and tax policy to change to get moderate Democrats and moderate Republicans on the same page. The filibuster can be avoided through budget reconciliation. So we do see some tax policy probably getting changed when all is needed is a 50% or over 50% vote. But there's limits to what budget reconciliation can even do. And so we think the reason we saw the best 2 months in the stock market, November and December post-election, we believe a lot of that was attributed to the fact that, from the standpoint of the market, we're going to get a higher stimulus and virtually little to no major tax policy change for the next year, maybe two, and then we run into the midterms and powers can shift, during the midterms. So from a market standpoint, this almost becomes the Goldilocks scenario, and I say that very apolitically, in that why we've seen the market move the way it's moved for the last 2.5 months. So policy is important, but policy is not everything, and it doesn't completely alter the course of a market that's in the middle of its newest bull secular market. So if we look back again in 2020, the U.S. economy was improving nicely after a modest slowdown in the fourth quarter of 2019, and then it skidded to obviously an abrupt stop. Pandemic happened, longest economic expansion ever, which was a little more than 10 years we had, and this recession was caused obviously by us closing businesses, and I say us by the government really closing businesses and people staying home in response to the pandemic. This was a pandemic-induced, self-inflicted shutdown, not a shutdown caused from economic overheat, which is your typical recession. And so you can kind of see here, this expansion we just finished, which is the farthest right bar graph, it was the longest expansion we've ever had. So we are in the middle of, I'd say the middle of the beginning of the next economic expansion. That's important because from an economic cycle standpoint, markets behave differently in different parts of the cycle of an economic expansion. And at the beginning, and we'll see a slide here later, the stock market tends to do pretty decently well in the beginning of an economic expansion. And we don't know how long that's going to last. If you look at the average since post World War II, the average has been over 5 years. But this graph clearly shows if you look back just the last 30 years or 40 years, your average is probably higher, closer to 7.5 or so years of an expansion, is what we've averaged. And so we're at the beginning of a new economic expansion, and that again is a positive thing in our economy, that we're getting out of the recession and moving, however path it's going to push forward. We are technically in an expansion.
Brian, one of the questions that just came in was in reference to innovation. Obviously, things happened in 2020. There was, businesses accelerated, capital acquisitions for computers and technologies. People began working from homes. In some situations, probably some business never even anticipated doing that, and they've now figured out they can work from home. The utilization of Zoom and GoToMeetings and things like that. How do you see? I think we both agree we don't see. That's not going to go away, but that innovation and the other types of innovations, manufacturing firms, have learned how to manufacture things, in some cases new products, in some cases, learned how to manufacture things faster than they had before. How do you see that affecting really where we're going here in 2021 and beyond?
That's a good question. I think that every change in a cycle into a new economic cycle kind of produces its own innovation. What I've kind of heard and read is you can almost take the 5 years of future technology innovations that were coming, and a lot of that got squeezed up into 1 year. Just like we'll talk about in the bond market, we think about 5 or so years of returns just got squeezed up into 1 year. And so you typically see an acceleration of things like that when people have to pivot. And clearly we all had to pivot in February, March, and April of how we did business. And so there's going to be certain parts of what ran our economy prior that might be under stress. You think of office real estate, and great time from an interest rate standpoint to be in real estate. Hot market out there in certain areas of the country as far as selling and valuations and new mortgages and new builds. But specifically, office real estate's going to have some trouble, and that might be long term. So other things are going to have trouble short term, and we're going to have to figure out innovations around that. I think of senior living facilities, and short term, huge negative for 2020 in how senior living facilities had were affected. But you get vaccinations and you get people more comfortable moving out of their homes into a community, and all of a sudden that could turn back to maybe a past normal. But you think of office real estate, and there is definitely a change potentially, and it's frankly a change that's been coming from the generations as well that have been growing up in this more, I want to be more free environment. I think we've had a lot of people I think we've heard talk about the millennial generation, and they're just so floating. They float around. They don't like to buy. They like to rent so they don't have to be tied down anywhere. They're starting families later in life. So we've already been trying to innovate around to satisfy the new generation, and I think we sped that up in 2020 with how do we work offsite? How do we satellite work? Think about being able to do business across the country, where before you were succumbed to who you could see face to face, and now so many people have adopted video conferencing that wouldn't have adopted it in 2019. You didn't have the ability. You could have invested in Zoom video in 2019, but if none of your potential clients or prospects wanted to do Zoom video or were comfortable with it or knew how, there was no market there. Now all of a sudden what's opened up is the ability to have those conversations and people being willing to, because they understand how this technology works. And the technology, changed and Zoom had to change its security measures pretty fast, right? Because they were getting people hacking into meetings. And so Microsoft Teams had to show that you can see more than 4 people during a live presentation, because boards were trying to meet using Teams, and it was impossible because you could only see 4 people. So, innovation was happening even in technology companies. And so I think, overall that's a positive. So overall that creates positive growth, and maybe it's going to create new industries. Who knows? Um, but I definitely think from the standpoint of has innovation been accelerated, I would say absolutely. So that's the good part. But this slide's not just, is not talking about the good things that happened in 2020, because there were some really devastating things I think that happened in 2020. Um, the economic recovery has been characterized by two different types of recoveries. And if you think from just the economy, the service part of the economy has been hampered by restrictions, while others like manufacturing and goods productions have moved forward at some of them record speeds. And that's led to what some people are calling this K-shaped recovery. Um, a K would have one part moving higher and improving, while the other part going lower, deteriorating. And it's common to have some of that, but we bifurcated pretty heavily in a lot of areas in the market in certain industries. But what's probably more upsetting is the change that happened from a wage standpoint in unemployment. The haves and have-nots, that the spread got bigger, and it's no fault of it's really a fault of the environment we were in. We lost, go back to April, we lost 20 million jobs in April. To put that in perspective, in 2008 and 9, in the financial crisis, what we called the Great Recession, our net loss of jobs was 8.8 million that we had to recover from. That recession that lasted 18 months. So we had 20 million jobs lost in April. Another statistic that I know I've shared with a few clients, weekly initial unemployment, people filing for new unemployment because they were laid off. Historically, it comes out every week, usually on Thursday. Just give you a perspective here, in a good economy. So let's say January 2020, we were in a great economic situation. Weekly initial filings, $250,000, $270,000, not uncommon. People filing for unemployment initially. 2008, 2009 recession, the worst unemployment filing week we had was 665,000 people in 1 week filed for unemployment. So, and our worst one ever was 1987, which was 695,000 people filed for unemployment. So that just gives you kind of the range that the graph was showing us over time. When we shut down our economy and the first unemployment weekly initial claim came out, it was like 3.2 million people. And we found out the next week that was pretty much wrong, because what happened was the websites all shut down because they couldn't handle how many people were jumping on it, because the next week it was 6.6 million people. And it came back down, and we're still sitting at weekly of in the 800, 900,000 people filing for initial unemployment. Now, the good news is people are also rolling off, and so that's why you're not seeing the unemployment rate go back up. But we lost 20 million jobs in April. We gained 10 million back at a record pace. We still have half of the people unemployed that we need to figure out how to get employed. And the problem, the thing that I believe is a sad thing, is that by a majority, the people who were reemployed were the higher wage earners. It's the lower wage earner job, the non-skilled worker type of job, that we're still trying to figure out how to get back up. And that's sad. That's an unfortunate thing, and I know that's at the height of the mind of every person out there in a leadership role, whether it's politically or corporately, of how do we get these jobs back? And it's not going to be easy, but that's what we're dealing with today. As we recover out of here, what we're looking for is how do we recover those jobs, and obviously there's different mindsets of how to do that. But to me, that was really the most disappointing thing that happened in 2020, and whether it was avoidable or not, it was unfortunate. So, from an economic standpoint, if we think GDP is what tracks, our growth. Kind of think of it as if the economy was a household and it created income. GDP is your income you make. And so when we talk about the economy and every 6 months with these webinars, we're talking about GDP and growth and what do we see? So in 2019, it was 2.2%. 2020 most likely will sit at the negative 4% or so mark, which is pretty drastic for a full year. But we expect 2021 to recover a lot of that economic loss that we saw in really what would be considered 2 quarters, if not even 1 quarter of economic activity. I think we had the worst quarterly economic reading ever, followed by the best economic reading ever. And so you could, as we continue to move forward in that trajectory out of growth, we believe 2021 should recover a lot of the loss economically that we saw. Internationally, so we go across outside of the U.S. and we look, we think developed countries are having, they had a lot more of a loss. You think of Europe and a lot of the problems that existed there. And I remember it was the UK that shut down again, what was it, a month or so ago for a period of time. So they've been dealing with this in different ways, and it's affected their economy a lot more than ours, and they're not going to come out of it as much as we think the U.S. will. They won't recover all that as fast. It's one of the reasons why we like U.S. based in our portfolio allocation right now versus developed countries. Emerging markets, however, they really seem to hit it in stride. They recovered a lot faster. A lot of the emerging markets, when you see emerging markets, if you peel back the onion, a lot of what you see is China. It's not just China. There's a lot of other emerging markets out there. But China really is a large piece of any emerging market makeup or index. And China may be the only country that in 2020 would have posted a positive GDP because of their response. Now, when you have a one-party system, it's easy to control. And so I think in other countries, in other emerging markets where there might not be so much of a one-party system, it was less likely to maybe control, an outbreak and get people back and working and whatnot. But we do think that there are still, there's a lot of middle class, where in the U.S. middle class is shrinking. In emerging markets, we see middle class continuing to grow, and we think that their GDPs are going to support the kind of growth that they've been experiencing historically. And so when we are looking internationally, we're heavily weighting in the emerging market area. Inflation. So inflation's an interesting topic. I think we talk about it a lot as when we're talking about stimulus and printing money and the sorts. Inflation is a key indicator for the Federal Reserve on when they're going to increase rates. And so if inflation gets too hot, the Fed will curb growth by increasing the federal funds rate. And they've been pretty telegraphed that they're not going to increase the Fed funds rate unless inflation not only gets to a point, which has kind of been the previous MO of the Fed, but really is to stay in a range for a while. And they've kind of inflated, they've fattened up that range. And that's important because what that means to us is if inflation doesn't move acceleratedly fast for more than maybe a few months, which could happen early on, but it could settle back down to a 1.5% or so rate. If it doesn't get to that 2.5% and sit there for a while, we could potentially see the Federal Reserve hold zero rate environment policy for a long time. I think the market's predicting the first federal funds increase rate to be in December of 2023. And if you look at the Federal Reserve dot plot graph they put out every time they meet and they vote on when they think rates should be, I don't even think it's 2023 at all is when they're saying it. So the point is, if inflation doesn't rear its ugly head in the next 3 or 4 years, we shouldn't really see the Fed move much at all on rates, and our rate environment should stay relatively the same. I also relate back to, let's go back to 2009, 2008, and when Ben Bernanke basically invented quantitative easing and kind of used that as a way to push forward. What happened? Two things. One, we never got the inflation we were expecting, and two, we had very sluggish economic growth. We feel like with the way that the government has responded, both the federal government, the Federal Reserve, and the U.S. government, we really believe that we should see a similar pattern at least for a while. We are going to have to reckon with our spending, our overspending, our debt levels. It's a 30, 40-year problem. But over the next economic cycle, we don't think that the levels that we're getting to are going to be enough to crater the U.S. dollar or change our reserve currency or things like that that could be, or push us into a heated up economy with a crash landing. And so we really see inflation lower for longer, which means we see rates lower for longer. And rates lower for longer is actually a really good environment for the stock market. Money is cheap. It allows us to grow without a higher cost behind it if we use leverage. And so those are things that we're looking at.
Brian, I would add to that. I also think the Federal Reserve, you go back to 2019 and, obviously the economy was picking up and GDP was picking up. And, the Jerome Powell, who has historically been hawkish on making moves, went ahead and elevated the rates and began to stall out the economy. And it was a good lesson, I think, in my eyes, for him, because I think he began to realize just how sensitive this whole model can be. And I do anticipate that was, maybe part of what's going on now. I mean, clearly they're looking, and just even before that under Janet Yellen, they were very transparent in the things that they were looking at, which was helpful for us. I mean, knowing what the Fed is looking at and the metrics that they're analyzing helps us understand the markets and those Fed moves as well. But I do anticipate that that 19 move probably has caused Paulson a little bit of, or not Paulson, but the current Fed, Powell, the more of a concern on, do I move rates higher sooner, or do I wait longer? And I think you're spot on. I think it's longer, lower.
It was an interesting, many of us still remember. I mean, it wasn't that long ago. Although 2020 seems like everything else was before that was like a lifetime ago. But in 2018, when really Jerome was taking his seat, and there was a little bit of a tugging back and forth with him and Trump, and Trump was wanting to slam rates down, partly because it helped his negotiations with China, which was obviously, he was wanting to increase kind of his negotiating power. But also, I think he maybe saw something that Jerome Powell didn't, and there's a little bit of a puffing of a chest, I think, that happened in 2018, and we saw what happened when he telegraphed the wrong move and what the markets did. I mean, 2018 almost became a bear market in and of itself, that fourth quarter, purely, well, I won't say purely, but largely because of Jerome Powell's, kind of needing to come to grips with what maybe policy should look like. And then we saw in 2019 him do all that reversal and then become very much more telegraphed. And when you've got a Janet Yellen sitting in her seat now with a Jerome Powell in his, a dove with a medium dove, if you want to use, Fed terms, so low rate, people who are much more easy policy. I think we're gonna know well in advance. The market's gonna know. We're gonna know when things are changing for them to want to start changing their policy.
Yeah, agreed.
So let's move to stocks. We've already talked. I've already talking about the economy. It's hard for me not to talk about stocks and bonds. So some of this maybe, we're not going to spend a ton of time extra because we've already been mentioning how the stock market's moving with the economic expansion we're in. But 2020 was one of the most difficult years we've experienced, and we saw that also in earnings. And earnings really just cratered. In fact, what was the most interesting thing, maybe from an earnings standpoint, was so many people didn't issue guidance. So many companies stopped issuing guidance because they had no clue how to guide, people of what they could expect in earnings through the rest of the year. And so, we actually had our best earnings surprise quarter in, I think, the second quarter of 2020. And it was a horrible number, but we were expecting way worse. And so when we're talking about earnings, what's really important to to the listeners and to investors is earnings is one of the main things that drives the value of the stock market. And so when you have very unknown future earnings, it becomes very hard to price in from the stock market standpoint how much we're willing to pay for those earnings we don't know exist. And so when we're looking at, another conversation we have a lot with people is the market too high? Is the market hot? The stock market. And I think the response that's appropriate is to say, well, let's look at two things. Let's look at earnings, and let's look at what are people willing to pay today for that earnings, and is it equally amongst all of the stock market diversified across all the different sectors? And I think that creates some very interesting conversations because earnings in general were very unknown for most of the year, and I think that's why we saw in March, 35% drop in 30 days from the top. Worst, fastest drop in the market in the history of the stock market, the history of it. And I think that was because we didn't know how to price the market. We didn't know because we didn't know what earnings were. And once we started to see there's a bifurcation happening, tech stocks actually did fine, and banks are still struggling, and energy companies are still struggling, and hospitality and leisure and restaurants are still struggling. Once we kind of understood how the pandemic was affecting us, we started to see earnings guidance change. And one of the things we're seeing in 2021 is earnings guidance is changing positively, where we're upping our earnings. And what's happening is what the stock market is showing right now. If we were to look at the price of the stock market today, or roundabouts today, the math actually didn't happen. It was maybe 15 days ago, when I say today. But in general terms, today's price of the market, if we expect earnings to be what they are saying they're going to be, then we're right now paying 22 to 24 times earnings. That is extremely high from a historical standpoint. But I want to point out a couple things. The first thing I want to point out is we're in a low interest rate environment, and we can argue, maybe we had some of this in our last expansion, but we can argue that we're in the lowest interest rate environment for maybe a longer period of time that we've ever been historically. So when we look at historical valuation numbers, what we have to understand is the value of a company is higher when interest rates are lower. And so historically, where PE ratios, the PE multiple, is 16 to 18 times earnings, and we're sitting at 22 to 24. The first thing I want to note is that we're in a very different interest rate environment than historically. And so we can feed a higher multiple because of the fact that cost of doing business is so much lower. So that's the first thing. The second thing is we don't really know what earnings will be. The estimated earnings for 2021 is about $160, look at the S&P, $160, $170 total. And I think the next slide actually has that, what LPLs.
Mm-hmm. Yeah.
So LPLs is $165. So right in the middle of that. So if the S&P is at what 3,800 and change or so today. I just looked over to CNBC and it's showing Bitcoin, so I'm not going to look at CNBC again. But if we're going to be at 3,800 and we're expecting $170 earnings per share in the S&P, that puts us at about a 22 times earnings. So basically, if we're going to hit 170 and we're comfortable with the 22 times earnings, well, we're there. This is a similar problem, by the way, that we had last year. In 2020, before we knew the pandemic, we were coming out with earnings estimates. And what was a little bit unnerving was earning estimates were showing that, hey, the first 3 weeks of January, we kind of hit our number. If we think people are going to be willing to pay this much for earnings, and we think this is going to be the earnings, well, that's what we're priced today. Mm-hmm. So where do we go from here? Do we throw it all in cash? And then we saw what happened. Not only do we have a pandemic and a recession and a bear market, and then a beginning of a bull market and a recovery and high stimulus, we ended the year the S&P up, 12, 15%. And so we have to take everything at the beginning of the year when we're projecting with a grain of salt. And the things I would say is we can support higher valuations, and we are not necessarily sure people are increasing their guidance for the rest of the year in this current earnings call season we're in. And what that's saying is any increase in earnings will automatically attribute to a higher justified price in the market. So think new highs in the S&P, but without increasing how much we're willing to pay for those earnings. And so that's a little technical, but what the point behind that is, while the stock market in general is priced fully, and we could even say a little expensive, um, historically the markets have stayed expensive for a while. And if we start timing when the market's going to not be expensive and when it's going to be expensive, you can get into timing the market ups and downs, and you can become extremely upset about how your results are in the meantime. So from an earnings standpoint, we do think on the stock market side that we're going to be volatile. We always are volatile. Even in good years, your average drop intra year is 10, 13%. So could we have another 10% pullback, a 15% pullback? Of course. Does it mean that we won't recover it by the end of the year and be able to continue to move forward and with the stock market continue to produce earnings? In the current environment we're in, with stimulus coming in and low tax policy effect probably happening, we think the market has some room to run. So I think the LPL, I've seen it as high as a 14% year to as low as a 5% year in the stock market. And the problem with being in wealth management is you don't show up the first day and they say, hey, congratulations, you're in wealth management. Here's the crystal ball. Good luck with all your clients. So we don't know. So, let me preface all this with saying we have no idea where we're going to end the year. But we look at the valuations and say they're full, but we don't say we are in a bubble that's about to burst. And there's a lot of people out there saying that. So we appreciate everyone's perspective for sure. From a Treasury standpoint, the U.S. 10-year Treasury is we're expecting to be higher this year. And I say higher almost laughing when I'm looking at the slide saying 1.25 to 1.75%. That's not a high number for the 10-year Treasury, historically for sure. And we got to a point back in 2020 when I think the 10-year Treasury was clipping a meager 0.3%. So we believe in a low interest rate environment in the U.S., maybe a more normalized 10-year Treasury is 1.25 to just under 2%. What does that mean for the bond market? We think that means when interest rates are going up, bond prices tend to have a little weight on them, and vice versa. We think that the bond market, as specifically relating to the Treasury market, is going to have a hard time making you money. It still can continue to be a good diversifier. Treasuries were a great diversifier in March, but if you held on to them for the rest of the year, you weren't very impressed. And we don't think that coming off of a 2019 when Jerome Powell was lowering rates, and then coming off of a 2020 when we then slammed him to the ground, we don't think 2021 is going to produce any sort of similar return than 2019 and 2020. And that's a conversation we need to start having with clients who are conservatively invested. Because if you've been in a pretty conservative model in 2019 and 2020, you maybe have experienced 7 to 9% returns for those 2 years. That's great, but the problem with that is that becomes a very bad expectation setter. And so what we want to be mindful of is if you want to create a normalized conservative return, you may have to go outside of treasuries and look in other areas of the market that haven't had that same recovery that the treasury market has had. And I think I just skipped through all of my bond slides by saying that. But let's finish up on the stock side, and then we're kind of running close on time. So this slide, what this is showing is the difference between a 1 year after a 30% decline in stocks and 2 years after a 30% bottom in stocks or greater. So once you hit kind of that 30% mark, wherever the bottom is, what did the next year do? What the next 2 years do? And what this graph is really showing is, stock markets get off to their recovery pretty fast. And this last one was no exception. I mean, we saw historically fast jump in the overall market. Um, and we can relate a lot that to the technology sector and the growth side of the market, and we can talk about growth versus value. And there's definitely that bifurcation that happened there. And is there going to be a rotation this year with more stimulus pushing maybe back to the spaces that are still being hurt? Energy didn't have that recovery. Banks didn't have that as a by and large have that recovery. Private debt didn't have that kind of recovery. So we're talking overall market here, but historically we didn't behave any different than than what we've behaved in the past in the kind of market environment we've had. But what also I want you to see is that the orange is showing the year after. The year after has never been negative. And again, the famous the worst four words you could ever say is this time it's different. That's kind of the saying in our industry. And so if you don't want to say this time is different, you want to look historically, it's not the same return. I wouldn't expect a 15% to 20% or 30 or 40% bounce, whatever the bounce actually happened at, from the beginning. It looks like it's about 55. But what it's saying is historically the market has continued to go forward. And you can actually relate that also to, and I don't have a graph for it, but historically what's happened in the beginning, the first term of a new president. And so regardless of the political association. And so again, it just lends some more credence to the fact that the stock market, I think, still has some room to run, whether it's getting super bubbly and hot or not. The behavior of the stock market, and we say this all the time, Brad and I, but Mark Twain's quote, history doesn't repeat itself, but it rhymes. If it's going to rhyme, then what you can expect is positive returns this year. And I say that very cautiously, very, very cautiously. This slide, I don't know if, Brad, are you able to see my
I am,
cursor?
yes. Mm-hmm.
Okay, so just to give you an idea, in 2021, LPL the consensus is a little less than the other forecasts out there, but just to give you some perspective, back to tax policy, if the tax policy fully went through, this increase here, you can cut in half. And so what I want to show in this slide, at least, and just say in this slide, is it does matter if there's major tax policy, if the corporate tax rate changes drastically or goes fully back to its old, which I don't think even Biden was saying to do that, but just to retain a higher C Corp rate, then that will be an immediate effect, albeit it could be short term in nature as it goes to how it affects long-term 12 to 24 months of future earnings. And while we use 12-month forward earnings as our number to decide if the market's too high, it starts feeling like a bit that the market's actually looking 24 months in advance after a year like last year to say, yeah, there might be some noise in the first year, but we can see where it's going after that, and so we're willing to have higher valuations because we know what's coming. And the truth is, the markets had great returns in higher tax policy years. Pre-2018, it's not like we never had a good stock market. And so when the C Corp rates went down, that was a great little boost to the earnings and profits. But we also had some great stock years prior to that with higher taxes. So the companies know how to make money when they're having to pay higher taxes. That's where the innovation conversation comes back in. All right, just a touch on bonds, and I kind of mentioned it. We really don't feel the Treasury market's going to give us a ton of return. We still say that the Treasury market is the purest form of in a traditional portfolio. It's the purest form of that little governor, that when the markets go down, it kind of stabilizes. But we don't think it means that if we have a non-recessionary year, that you're going to see a lot of returns happening. We don't think there's going to be a lot of returns in the Treasury market because we're very historically at low levels. So what we're turning to is maybe looking at high quality bonds that have not had the same market returns and recovery that the Treasuries have. We think in the muni space there's some really interesting strength there, especially given some of the stimulus facilities that were put in place. The high yield market. Yeah, I mean, right now, year to date, I think it was a day or two ago, but the only positive part of the bond market was the high yield space and the bank loan space. And so, again, if we may need to move outside of our normal bounds a bit and have a little of exposure in other areas in the bond market in order to allow for some return to happen in that space. Because again, with interest rates low, it's really hard to create income, and if we have increasing rate environment, it also makes it harder for the prices to go up. So moving away from treasuries, but to other areas of somewhat safe, but finding more income, and then even moving some money into the higher yielding space, we think are good things to be looking at. So really, at the end of the day, I mean, we hope we've come across that we're not in this great space. We're not sitting with like 2018, end of 2018. We're in 2019. We're like, look, no one's buying earnings right now. This is a great time to be investing, and it sure was. 2019 was a great year. We're not sitting in that kind of environment, but we don't think we're sitting in an environment where the only place we can go is down from here. Whether you're thinking it politically or you're thinking it from earnings valuations or the tech market's too hot. A lot of those there's a lot of truth in a lot of those statements, and we want to be mindful of that. But we don't think blanket comment that it means that the markets are going to have a horrible year, and that we need to shove more money in cash or bonds or gold. And so hopefully you walk away with just a good reminder that stay long term in your allocations you make, because the year to year, the decision making that we can try to make in the middle of a year based off of things that are happening today can have drastically negative, consequences. And we saw that in March and April of last year. I mean, a lot of people wanting to go to cash, or people going to cash, or investment advisors going to cash. I heard of a not in our area and region, thankfully, but there was an advisor firm I know that did that, and they, I don't know if they're still in cash or not, but you get paralyzed when you do that, and that wasn't what their job was. And so it's easy to become emotional with our money when we see the markets move quickly, and the hope is that we give you some guidance this year on having a long-term perspective and kind of feeling a well-rounded perspective of what's going on, and then using that plus your access to your advisors and to those around you to continue to make rational decisions. I will say this from a personal standpoint, and then Brad, I'll turn it back over to you. But I saw the most rational investor I've ever seen through March and April. Yes, there were some that had to make certain moves, and some that made moves out of fear. But I was extremely impressed with the 2020 behavior in finance that I saw with the clients that we talked to. And I think some of that has to do with a lot of them still remember 2008 and 9, and hey, the stock market didn't go to zero. And I actually saw more people be aggressive when it was the right time to be aggressive. And so, I think as we continue to learn from our past experiences, it helps us make good decisions for our future. And hopefully this presentation today helped in some way. Brad, I'll turn it back over to you.
Thanks, Brian. Yeah, and I agree with kind of your summary there. I mean, I really pull out, three main thoughts out of this. The first one is as Brian, as you suggested, having a well-balanced allocation that matches with your goals and your objectives and your strategy, staying the course and trying not to become transactional. There's a number of studies that have been done that, demonstrate and show that we're twice as afraid and motivated then to make changes to our portfolio because we're afraid of a loss than we are equally excited about the opportunity of making a gain. And so it's very easy to get drugged down into the transactional thinking and say, sell all, I want to get out. And we really try to encourage our clients to be less transactional and more thoughtful and long-term and using that planning type strategy. Second point, is that, we do have kind of a case structured market as Brian showed. I think it's easier for each of us to from our own particular perspective to look at the market. And if maybe if we're experiencing the down sloping leg of the K economy, to be very pessimistic about the opportunities ahead. And if we're on the upside leg of the K, we're very optimistic about what we see. I'm reminded of an old coach that said, the world is generally never as good as you think of it, nor is it nearly as bad as you think it. It's usually something in between. And so recognizing that there's more going out there than maybe just what we are seeing with, possibly our just emotional blinders on. Third point, again, back to kind of one of the earlier slides is, recognize that growth is possible regardless of the makeup of government, and just to, continue to realize that, each of these, that the market ahead of us, it may not give us the gains or the returns that we want, but it doesn't mean that just because our government is more aligned at this point in time politically, it doesn't mean that that means that the returns are negative. There are gains that are possible. So I guess that's my kind of closing thoughts. I do want to thank you all for joining us for the Outlook, and for making it through the important disclosures that we have to put up there. I do apologize for all of those. We've really enjoyed being able to kind of share with you our insights and the outlook on the economy and the markets ahead. As I mentioned earlier at the beginning of the presentation, we do have copies of these slides available. So if you want some copies, I can send you a PDF of those, or we do have a color booklet that we'd be happy to mail out to you. So please feel free to reach out to Brian and I, and just let us know that you'd like a copy, and we will be most happy to send it out to you. And with that, I think that that'll about wrap us up. I do appreciate it, and I wish you all the very best, and look forward to talking to you again here in a few months. Take care.
Thank you. Yeah, and please let us know if you need a copy. We had some questions come in about sharing the slides. While we can't share the slides, we should have a video of this at some point. But we do that booklet that we have that we'll send out either electronically or physical, has all those pictures in there. So feel free to ask us for those, and we can happily get those to you. We will. And as you can see from these pictures, it was a okay year for Brad and I, because we didn't have to lose hair from what happened in 2020. We really just never have had it. So no, but thank you again, and please call us or let us know if you have any other questions.